Welcome everyone to a new episode of Invest Horizon, organized by ESE, Vector, BPI, Meta, BWCon, Eura, EVN, and more. Today we are going to discuss funding rounds. So are you a European deep tech entrepreneur crafting your next funding strategy? Now to start on a bit on introduction, market volatility, depending on the index that we try to check, we have seen how has increased between 2 to 6 times in the past months. Not only that, if we go to databases such as Crunchbase, we have seen that the volume of venture deals has decreased based on that volatility around 20%, making more challenging to raise funding for deep tech entrepreneurs. Now, what we're going to try to tackle today is how to choose the right type of investors at the right time, how to strengthen your investment readiness as an European deep tech entrepreneur, and how to negotiate those tricky clauses of your investment term sheet. Today we have a wonderful, great panel of speakers. For the first one, Andrei, we have seen your profile, which is impressive. You see a lot of deals as a head of corporate venture capital at EFKO, and also with previous experience in fiscal and education in Mutua and Duke University. Could you share your view, perspective about this situation?
Thank you very much, Josemaria, for the great question. And I'm glad to be on such a distinguished panel with distinguished speakers. And I appreciate attention of the audience, and good afternoon, everyone. So first of all, let me start with a few items. Definitely the business environment in Russia was seriously impacted by COVID. And more than that, as you know, as economy of the country is seriously dependent on the mineral wealth, if I may say so, which comes from the export of oil and gas. We seriously depend on the oil price, which went down significantly at to 2020. And then as a result, we see serious exchange rate effect, which devalued ruble for 30 to 40%, and in the peak times, this was almost double devaluation, which apparently discouraged certain investors from investing, as they do have a ruble mass, which gave them less dollars than usually done. And therefore, they just withdraw from any risk investments, not only because venture capital brings certain risk profile to any investment, but because of uncertainty related more to economy rather than to the asset class itself. That's point number one. The point number two is that as soon as we experience economical turbulence, our local venture market is seriously dependent on the government and state sources. So we do have overall, in terms of state ownership, directly or indirectly, according to local anti-monopoly services, government owns over 70% of the economy. As such, we do have serious dependence on government sources of support of such a young and nascent stage as venture investments and startups. And therefore, we saw serious cutbacks for major development institutions who said, okay, we stop producing grant financing, for instance, as it was done in Skolkovo Foundation, one of the development institutions that's supposed to support startups, and they have over 1,000 of the startups in their portfolio. So they said, okay, we stop somewhere in the middle of the year, any grant funding till 2021, okay? And then we did have a very small number of private investors which really located within the country. And if they invest something, being the Russian investors, they prefer to invest in companies outside of Russian domain, as the local market is pretty small, and therefore they look for the opportunities to seed those investments outside of Russia, either in Europe, in the United States, or in Israel. And as soon as we don't have the venture market itself as a large component of economy, delivering very good startups to nutrition economy itself, the level of attention to support those startups and venture funds themselves was very, very limited from the government, if any, compared to Europe, for instance, where European Investment Fund, I know that supports different funds. And two last items very shortly. First of all, is definitely the regulation. So we did have certain regulatory approvals when government suggested that state money should be invested only into the local jurisdiction, and that creates certain tension with companies incorporated outside of Russian domain, and therefore limits the participation of foreign investors in good deals in Russia, because the business climate, the business environment wasn't that good, with certain deviations, if I may say so. And last one, we recently saw the launch of the government, probably the right efforts to restructure all innovation support development institutions. So they said there is a state corporation called BeAble, and that will be the platform for all development institutions reshuffling and modernization. So therefore, my view of the situation in Russia in a nutshell, it's completely different from what we saw, at least from the press in Europe, in the United Kingdom. Thank you.
And connecting your thoughts also with Isaac. Isaac, what do you think, how is compared these thoughts that Andrei has shared to the US and this unique bridge that you are doing, connecting the US with the Southwest of Europe as general partner at Conexo Ventures, where you do this bridge, and also with your experience and backgrounds in HBS and MIT?
Yeah, thanks, Josemaria. You're right, that's precisely what we do at Conexo, connecting innovation from all Europe, but especially from Southern Europe towards US, and allowing entrepreneurs that have growing companies to look for markets and rounds in the north of America, where there's more space for this kind of innovation. So it's very interesting, because you were mentioning earlier the CBOA Market Volatility Index. And interestingly, this index is basically a deviation from the mean. So it increases when the market goes down sharply, but it also increases when the market goes up sharply. So that's precisely what happened this year as compared to 2008, right? In 2008, it went down sharply and stayed there. But what happened this year is that, yes, during the first half of the year, it went down sharply due to uncertainty around COVID, and we didn't know what was going to happen with it. But as the year progressed and the situation got more or less under control in many countries, and we look for a better future, the market recovered very quickly. And you could see that now the US markets, you know, NASDAQ, the SP 500, all those markets are on maximums, on historic maximums. And the same happened also in the venture capital side. If you look at data specifically for South Europe, for Spain, and I'm quoting information from the Banquito Foundation Startup Observatory, we are also in record years. It's reported that this year will end with more than 1 billion in funding for startups at all stages, which is a small increase from last year. It's 6.3% higher than last year. But what is most interesting is that the number of startups that receive that funding has increased dramatically. It's 312 startups so far in the year, which is 43% up year over year, which is very, very interesting. So really, the market is heating up. We passed from a big holding up in the first half of the year to a big catch up in the second part. And this is even if you remove the mega rounds of 50 million plus across all sectors, the growth is there. However, it's not equally distributed among industries. If you look, for instance, at the big winners are those that enhance digitalization, because the world is moving towards digital. For instance, cybersecurity is up in funding 108%, and in number of deals, 175%. In contrary, if you look at travel, it's down 61% and 60% in funding for the year. But if you look at prop tech, it's at minus 92%. It's practically flat. It's very sad, but also shows a very interesting trend here. That is, yes, people travel less, but if you look at property management, the real trend here is that things are moving digital. The physical location matters less and less. So in this context, yes, there's acceleration, there's more interest in doing deals, and this brings even more attention outside of US. We are starting to see not only US investors that are receptive towards looking at deals from outside of US, but they actively go into Southern Europe and looking for the deals directly. So we are starting to see competition and investment from funds such as Sequoia, Axel, all the big funds in US are setting up operations not only in the north of Europe, but also in the south of Europe, which is very interesting.
This gives us a perspective of Europe, its connectivity to the US. I would like also to zoom in, and this question is for Almudena, on the deep tech arena. And you have this perspective from your from your fund as a founding partner and chair of BeAble Capital, that you specialize in these high-tech and tech transfer investments. Additionally, you have also a unique perspective, not only from the funding side, but also from the, let's say, the discovery or the scientific part, no? With your PhD in molecular biology, and also several collaborations with the Spanish National Research Council. My question is, how do you see these changes in the market are going to directly affect deep tech entrepreneurs in terms of fundraising?
Okay, I think that in general terms, the COVID-19 crisis has put on the table how a health or environmental crisis can change the entire status quo of a society. And therefore, the tech companies which provide solutions to this crisis have gained in importance, and hence it's expected that more public resources will be allocated to them. However, the contraction of many industries and the high level of uncertainty has caused a slowdown in the introduction of innovation in the markets, and its reactivation will be closely linked to the economic recovery. But unfortunately, environmental and sustainability challenges cannot be delayed. And for this reason, I think that regulation may need to play a key role in driving further innovation in the market.
Mm-hmm. So regulation is also affecting, I would say, some of the funding mechanisms. One of those are accelerators, are VC funds, and other type of funds. I would like to shoot the next question to Thomas. Thomas, to have this also quite a strong perspective as a senior investor at Plug and Play, but also you have been working in big corporations such as Aston Martin. What do you think from the acceleration funding perspective is going to affect or is affecting?
Of course. Thanks a lot, Josemaria, for the invitation and for asking this great question. So as you said, on top of accelerating startups through our corporate innovation services, Plug and Play is also one of the most active VC in the world. So we are investing in roughly 200 startups per annum. And since the beginning of the pandemic, as most of the VC funds, as you can imagine, we have been totally freezing our investment pipeline to focus exclusively on portfolio management back in roughly March. And after only 1 month, in mid-April, we started investing again in great startups. As several of them, they managed to grow even faster with their existing business models, thanks to the new way of living, new way of working, that brought them great tractions. But some others were agile enough to create new revenue streams during the pandemic, when they saw new opportunities arising, for example. So undoubtedly, what I would say, some industries got hit harder than some others, as we mentioned before, like the travel and hospitality industry. It has been more complicated for some startups to survive. However, what we have seen in the startup scene is that most of the startups were not actually surviving, but they were striving to continue their growth. And it's what we've seen so far, and we've been surprised as most of the VC fund or other innovation firms. But depending on the current or actually new business models of the startups, their growth rate might be different. It depends also on their industries, of course. But it has been relatively easy to find funding after the first confinement. To illustrate my thought, so at Plug and Play, in 2020, we had 6 new unicorns this year only, with 3 additional ones since April. So Applyboard in the education sector, Bigagli in the cybersecurity, and Customer in the retail space that actually just got acquired on Monday by Facebook for over $1 billion. And we've realized also that a lot of companies were raising funds during the first confinement, some of our portfolio companies. And this is why we actually started doing a series of webinars called How to Raise Money During a Pandemic. And a really interesting one that actually I would advise all of the audience to watch is how Onfido managed to raise 100 million in April. So to sum up, I think, in crises are cycles. Every 10 years, roughly, we have new crises. And we have seen in 2008 that some great startups got launched, actually, such as Uber or Airbnb, for example. And surprisingly enough, it's like the translation of it's Said Hamidi, our CEO, we said this during the first confinement. crisis in Chinese is actually danger and opportunity, right? Put together. And in all of the crises, you have some opportunity, and you need to see the silver linings and catch these opportunities in order to push your startup to grow. And of course, you need to be agile enough to adapt your startup to the current changes.
Here I listened some good news, some hope, and so far we have here the perspective from corporations, from VCs, from acceleration. What's the perspective from the angel investment? And this question is for you, Juan. So you have also a unique perspective in this panel. You are both working in a startup in the high tech arena, and also you are an angel investor. Also with and not in any startup. You have recently won the Restarting Together Challenge Prize among 500 other startups. So my question for you is, from the angel investment perspective, how is affecting the deep tech arena the recent months, and what can we do about it?
Thank you. Good afternoon, everyone. Yes, as an angel investor, I have to tell you that I don't believe that looking at the stock market volatility is a good investment approach. When I invest, I always have an exit horizon of 10 years. So to me, this is a long-term play. And I value more disruptive technologies, problem solved, solid business plans, and obviously the founder's expertise. So once I have validated the market opportunity, what is important to me is to know how far from go-to-market a minimum viable product is, and the capability of the management team to execute the strategy. So I don't think that there should be a deterrent today. And I really an example. So we just closed a 5 million investment in addition to winning this Restarting Together contest. And that's a good thing about investing in B2B, AI, and software companies. I think they are less prone to volatility than the consumer market. So for me, I believe that if the investment fundamentals are there, they are good, it's not a good strategy to look at the stock market volatility. This is a long play. And this is what I've been doing for many years, and it's working fine. So at the end of the day, if the companies, they have a good team, they have a good technology, a good execution, this only will be a bump in the road. That's what I think.
Right. So if we don't see, or we don't check, or we don't focus on that levels of volatility, I would like to know what we have to focus on. And the following question is for Carmen. Carmen, one of the questions that we advanced in the panel that we were going to solve is, when is the right time, the right type of investor, but also the right time to engage and start up with a corporation. You have a really strong experience as a corporate innovator in big companies such as BeAble, Mutua, Madrileña, Deloitte. My question for you is, when is the right time and startup to engage with a corporation? But from the, I would say, from the corporate perspective, what are the financial and strategic KPIs to identify, hey, this is the right moment to work with a deep tech entrepreneur? And maybe here you can cite things such as the TRL, or what's your preference between early stage or later stage startups? Thank you.
Hey, thanks so much for the invitation. It's been a really interesting panel, and thank you so much for all the previous speakers, because I'm really learning a lot from you. And nice to see old friends as Thomas. Nice to see you again. Well, from the corporate side, I can tell you what's the theory, and I can tell you what we're doing now. The theory, and it is very related to the status of the TRL, so the status of the technology, and also when's the perfect moment how to engage with a new startup. We apply several criteria, but there are some that are really obvious, but no everybody applies the same. The first one is the strategic alignment between the corporate and the startup. This is something really easy to explain and not really easy to apply, because normally the startups are not strategically aligned with the corporates. It's not a matter of time, it's not a matter of speed, it's a matter of corporates are focused in one sector, normally technological startups are trying to be as much horizontal as possible. So this is the first one, this is the first challenge. The second one is the legal framework. I'm not saying we find a lot of illegals opportunity. What I'm going to say is in terms of, for example, of GDPR, normally new opportunities stress as much as they can the legal framework to really be the very good opportunity and to find this what is going to make the next unicorn. So what makes the difference? This is the second one. The third one is the feasibility. It means it's going to be scalable, it's going to be sustainable, so it could work with our internal departments, our corporate departments. And the fourth criteria we apply is the impact. And when I say impact, we say financial and also social impact. So we are not working with companies where we are going to lose money in the long term. So we assume we are going to invest, but we are not losing money finally. And we are not investing in companies that are not going to provide a positive impact in terms of obviously economic or social or sustainability, things like that. So those are the four criteria we apply. Are really challenging. So this is the first thing. And this is the theory. And what is happening now, especially with COVID, is that the pandemic has stressed as much as possible our decision process. So previously, Zach, for example, has mentioned the PropTech. As Mutua Madrileña, we are in the insurance sector, we are in the PropTech sector, and we are also in the wealth management. Starting from the last one, in the wealth management, not a lot of people is investing now. So we can see very good opportunities, but Thomas has said they are trying to foster the follow-on. So going with the companies, not investing in or not opening the market to new opportunities, or trying to keep the core plug and play. So this is exactly what we are finding. For example, in the insurance company, what we are seeing is the very good opportunities that could go from an early stage round to E series or B series. It could take like 2 years from one to the other. And now we are seeing these stages are becoming shorter and shorter, what means we need to be ready as soon as possible instead of paying a lot of money. And we need to define which strategic impact we want to obtain and what business area are going to support this investment opportunity. So we need to build the business case at the same time as we are doing the due diligence. So it means all the company needs to be working at the same time for analyzing an investing opportunity. For the innovation department, this is a really, really great deal because it means we can go at the same speed as the startups. But I'm not sure if it's going to be sustainable for the next year. So I think this is a very good learning, but we need to keep moving in the same path.
Mm-hmm. You mentioned, Carmen, being investment ready, but what we have seen is that from the entrepreneur perspective, when they are ready, they don't know how much to raise. And the following question is for you, Thomas. Just to be aware, all panelists in this second round that we are going to do, you're going to have not more than 1 minute to provide the answer. So try to be short and sharp. For starting with you, Thomas, I know it's a challenge, but you are very smart, all of you. We can do it. So Thomas, my question for you. If a deep tech entrepreneur is looking to the next funding round and is calculating the amount of money he or she have to raise, and they usually struggle between, I am focusing in a smaller round, more on the short term, or in a bigger round in the more longer term. How to calculate that? What are the top 1 recommendations from you?
Great question, Josemaria. Thanks a lot. And nice to meet you again, also, Carmen. So as you said, it's a really important point. I mean, CEOs of a startup are spending most of their time doing forecasts and trying to fundraise. But I think you should raise money if and when you need it to achieve your next milestone. So achieving milestone, they will increase, of course, the value of your company. and you will have the trouble raising new rounds unless you have increased the value of your enterprise, right? So your milestone plan and your financing plan are really actually dependent on each other. But in a nutshell, I think my 3 advices will be, first, that you need to spend some time figuring out in detail what are your next 1 to 3 milestones in maybe the upcoming months, max a year. Then you should determine how much time, money, and other resources such as human capital you will need to actually reach this milestone. And lastly, maybe doing comparables in your respective industry. Like this, you can analyze the growth rate and improve your forecast of revenue, expenses, cash flow management, and to try to find the perfect timing for you to raise this fund. Because your objective is to raise enough money to get you past an important milestone and to convince the investor you are going to speak with that you have reached, that you are raising money to reach this milestone and not actually just investing in this company. It's a good use of money. It's to reach a certain goal. Another good advice, and the last one that I will give, is depending on your business model, you can also try to not raise money through VC funding, not to dilute yourself too much, at the beginning. What I will do, potentially, there is a bunch right now of new alternative funding solutions, such as CapShares or ClickFunds, that you could use in order to loan money with a small interest rate and not exchanging equity against of some funding.
Mm-hmm. And what if we are investment ready? We know the amount we want to raise. Who is the best investor in the room? So today we have from business angels, venture capital, corporations, accelerations. We have a quite broad spectrum of investors. My question for Andrei is for you, is what a corporation can provide that is unique compared to a VC? So in other words, what's better, a corporate VC or a private VC for a deep tech entrepreneur?
Yeah, thank you very much, Josemaria. I mean, indeed, according to the recent report, we referred to the valuations went up significantly at all stages. And sometimes they went up as well as already been discussed because of the economical situation, the pendulum, but also anticipating great exits, which we all observed in 2020, like, Snowflake, Palantir, Asanas, and not to say the Slack's recent sale of huge amount of money. Therefore, the all investors got a lot of dry powder on hands at the funds level, okay, to invest. And therefore, we see this investment going up. But as Thomas said, it's also remarkable that timing, which usually comprised over 2 years, now sharply reduced to 1.1 to 1.8 years between the different investment rounds, okay? And what is interesting is that historically, the corporate venture capital comprised over 1/3 of all venture investments worldwide. And according to NVCA statistics, over half of all deals in the US took place with corporate venture business, right? And therefore, back to the point, there is no single silver bullet which will say, okay, this particular case you should go to a corporate investor and this one is the regular venture fund. And the reason being is as follows. First of all, you do have certain industries where you need to have and comply with very strict rules of regulation. For instance, we work in the industry of food and beverage. So without any certification, you wouldn't be able to go on the market and launch your product unless it's delivery product, okay? IT related. Therefore, you need to get a partner who would navigate you through these regulatory hurdles. And if it's completely new category, like for instance, cultured meat, you need to have a partnership and consortium which will bring you towards regulator and you will pitch your story alongside with large partners, right? Point number one. Point number two, you need to have an expertise, and definitely in venture world and classical venture world, you can collect that expertise if it's something, well, from historical experience of venture investors or people from the industry. But if this is a cross-industrial expertise, like it happens in the very complex value chains, again, food and beverage or healthcare might be one of the two examples, it's very sophisticated areas where you need to have people from different pieces of this value chain to get expertise from, okay? And another point is that, okay, you need maybe to run a joint R&D project with large corporate because your product should be tailored to the local needs. One of the examples perfectly fit in the examples I'm giving, like a food industry, that you may have to use different sources of your source materials, like, ingredients, plants, anything similar. And it might be different from, let's say, Russia, Canada, United States, or China. And therefore, you have to adjust these products to the local needs in order to reduce pricing and logistical component of your business, not to supply that from somewhere else. And again, in terms of stages, it's interesting story because it might be as early as seed stage, as we observed in many cases, like Tyson Ventures, for instance, invested in Memphis Feeds. Companies far from market achievement, but they already got support from the corporate. On the other hand, it might be a late stage support, like we observed in many rounds of Impossible Foods, where they've invested a significant amount of money, got money from sovereign funds as well. Now, and the reason being, very interesting to observe from the startup's perspective. And one of the examples I want to give you is Tyson Food itself, Tyson Ventures, because it's interesting to see for the startup why corporate might be interested to work with them. It's a traditional meat production company, while they've announced they want to be a protein supplier. So regardless of the source of this protein, it might be alternative or clean meat, whatever. And apparently it means that startup might be interested to find this early partner who is interested not only to give money, but to learn from startups as well, to explore the new market, to understand how good that market and potentially profitable it is. Not just hype, but very interesting project to participate in. And the similar story we have across different technologies, like, sweet proteins and many others. So that's in a nutshell my view on that.
Juan, do you agree? As an angel investor, what's better, the corporate and VC, or an angel investor, and why?
Well, I should agree because I'm minority here, so I think there's a lot of power against me here. No, just kidding. Well, we angel investors, we invest at early stage at companies, and for us it's more important the market opportunity and the founders' skills, as I said before, more important than current profit or sales. So we are willing to take a bigger risk, and we have longer exit goals than VCs. That's important for very early companies. And because normally we are people with a lot of business experience, we tend to invest in industries we know very well. And this implies potential customers and a lot of knowledge for startups. So this is important to consider. And this is what I'm doing, for instance, for Ariel. I mean, as an investor, very early investor in the company, I'm bringing my 35 years experience and contacts network in the telecom market in order to help the company take off. And this is what Ariel does, because it's an AI Wi-Fi sensing intelligence company from Canada, and the main customers are in the telecoms market. So on the other hand, VCs are very important. So I have to tell you that when companies they want to scale big and fast and they need large amount of money, the VCs are key. So they do this for a living. So it means a lot of resources in terms of people, in terms of support, and other companies as well, other investors that are associated to these VCs. So this business and institutional knowledge is very important to companies. And what they do is really to professionalize the company and bring structure. But on the other hand, what happens is that because they invest a lot of money, so they have the expectation is a quick return or a quick exit. So we angel investors, as I said before, my investment horizon is 10 years. So I want to get very early, so I get a very low price of the shares of the company, but I need to be very patient. The VCs, they can later stage. And sometimes, because they invest a lot of money, the founders may lose majority of the management control of the company. And for some companies at early stage, I don't think it's a good thing that the founders lose management control or majority of the company, because they need time to secure their vision and their strategy. But for me, both are very important. And depends on the stage of the life cycle of the company or the startup. choosing VCs over angel investors depends on this, on how much money you want to scale big, or you want to keep control of the company. This is the things that entrepreneurs or founders, they need to consider before making a decision about VCs or angel investors. But both of those are very important, complementary and necessary.
From here, we have here the perspective from the corporate side, from the angel side. Maybe later we will hear also the perspective from the pure VC side. But meanwhile, I would like to know the following, that we have tried to understand, to shed light on who is the right investor, how much to raise. But once we know that and we are investment ready, how to approach the investors. And Almudena, the next question is for you. So what is if I am a European deep tech entrepreneur and tomorrow at 9 a.m. I want to start my fundraising, how is the right approach? How can I find and approach those investors? And maybe here you can cite things such as specific databases, specific events in Europe, or platforms.
Okay, Josemaria. Yeah, I think it's important to find out association and programs at national level and European level. For example, Horizon is a clear example that fit the type of project that you are. Also, events like, for example, Hello Tomorrow are a good place to have a one-to-one meeting with tech investors. Also, you can look at private equity association, such as ASCRI in Spain, for example, because it's a good place to find out which funds are operating in your sector and the stage of development that you have, for example, in pre-seed, seed, Series A. EIF webpage, I think, is also a good source to check funds with investment strategies that can fit with you. And in Spain, for example, at the national level, CDTI is a great place to find funds focused on pharma or ICT, deep tech, for example.
Mm-hmm. So with this, we have covered kind of all the steps, but now it's arrived the moment where the entrepreneur is with one of you as an investor and has to agree on the term sheet. And I have the two last questions, maybe one for Carmen and one for Isaac. Carmen, my question for you is, what are the advantages and what recommendations at that moment do you suggest for a deep tech entrepreneur? Carmen.
Yeah, I start. Recommendation for a deep tech entrepreneur. The first one, well, you've previously asked, what about having a corporate as an investor? So it's really related with the recommendation. The first one is to make the process, or make the technology scalable and to make it applicable to different sectors. Because, for example, if the technology is applied to understanding the customer, even a corporate very focused on one sector could invest looking for this technology. As much scalable is it, the enter barrier will be higher, and also it will be more efficient. So the first one, not to be focused on one sector. Trying to be really sincere with the team. We are seeing in some investments, or well, we have several times the question coming from the business units: how do you know this company is not going to be a write-off? And we don't know. We don't know the future. We don't know if this company is going to be a write-off and we are going to lose all the money. But what we do is we trust in the team. We trust in the developers, and we trust on the criteria that they are applying to evolve and to increase and improve the business model. So those two for me are the most investment. The first one very related to the technology, and the second one is very related to the knowledge, to really understand who is providing value to this technology and who's not. And for me, and this is the third one in terms of having a corporate as an investor, we are now fighting really hard to be an investor in really good opportunities. And one of our main provider has said, and he's really just in the middle of a round and has said to us, no, I don't want you in my as an investor, as an LP, because I don't want to show to the market I'm just going to be focused in the insurance sector. And we've really understood, and this really related with the previously recommendation I've said. And we've understood that what we are doing is trying to improve the business and trying to give them a good position in terms of keep working with us, because we think this is the only way to help these new projects, and is a calling effect for other really good opportunities. And now what we are doing is to keep working and wait for the next round and hope to be able to enter in the cap table.
So you mentioned technology, knowledge, the dominoes effect. Coming back to the previous question connected with this one and your comments, is for you, Isaac, that is, what is the when signing, when is the right moment, when they are those deep tech entrepreneurs negotiating the term sheet? What is the trickiest clause they have to be aware, or a red flag? What is the top one recommendation at that moment, the trickiest clause to keep in the radar?
Right. Yeah. Thanks, Josemaria. First, before that, I would say that the right moment to raise the money is when you don't need it. Right? You have to be aware that even though we have record funding numbers, it may be the case that we have a second confinement, or just your startup doesn't raise the attention at the right time, and the times are delayed. So never raise the money when you are desperate, when you're at the moment that you have only 2-3 months until you need a liquidity event, because that may not happen, right? And when you are nervous, when you're stressed, your pitch is not at the level of the quality that IBC would expect, and we are in a business of trust. You need to convey trust and confidence. If you are stressed because you have a deadline coming up, you're not going to do it. But assuming that you have negotiation power and you have the calm to get into this kind of negotiation, think that also is an asymmetric relationship, because even though the term sheet normally is non-binding, it's non-binding for only one side. So the VC can walk out of the deal, but the company normally cannot walk out of the deal. They assume that if things go smoothly towards a close, that's going to be their investor. So they give a binding period of exclusivity for a month or a month and a half. So think hard if this is the fund, if this is the one, right? Think about it as if it is a relationship or a marriage. Is this the one? Because it's not a time to fool around. It's a time to commit and a time to expect that if everything goes smoothly, that's going to happen. You're giving away a month or a month and a half of your funding period to this partner, and it may not happen. So make sure that it's a serious partner and is really committed to make it happen. Then in terms of the clauses, I see many first-time entrepreneurs or young entrepreneurs fixated on valuation, and that may not be the most important thing long-term, as Juan Felipe was saying. Worry more about control, more about your ability to execute that vision that you have on the long term. You need to understand that economic rights and management rights can be together, but can be separate also. If you commit to have a minority on the board, or if you commit to very strict veto clauses given to your investors on specific topics, you may giving away key control points in your company that when the time comes that you are not aligned with your investors, you're not going to be able to execute your vision. So that's one of the things that you need to be very careful to control about.
Thank you. So with this, we have, in summarizing the panel of today, we have tried to understand, to shed light on who is the right type of investor for as an entrepreneur and the right time, and also what are kind of the what are the consequences and trends of what we have experienced in the past months. And finally, what are some of the tricks and tips to consider when doing that negotiation of the agreement of the term sheet with the investor? Then, if you want to learn more about some of the research that we are providing in terms of the so-called the European Valley of Death, this lack of funding for proof of concept in Europe, and some of the mechanisms from business angels, VCs, CVCs, and public funds are trying to tackle that. Here you have more information. Moreover, if you want to hear more about Invest Horizon and the forthcoming events, here also you have the complete agenda. It has been a real honor. Andrei, Almudena, Isaac, Carmen, Thomas, Juan, and Victoria, who has been in the background organizing everything. You are great. Thank you very much and keep in touch.